Non-farm payrolls just dropped, market volatility is surging, and interest rates are on the line. As of April 3, 2026, jobs growth is slowing, inflation is rising. Here is what every investor needs to know, and exactly how each market sector will be affected. Non-farm payrolls is the most anticipated monthly jobs report, and for good reason, as it has a profound impact on market dynamics. This economic release measures the change in the number of people employed in the United States, excluding farm workers, which accounts for approximately 80% of the workforce. The market watches this report so closely because it provides insight into the overall health of the labor market, and by extension, the broader economy. A strong jobs report can lead to increased expectations of Fed hawkishness, potentially resulting in higher interest rates, while a weak report may lead to rate cut pricing and a more dovish stance from the central bank. Currently, the consensus expectation is for a moderate increase in payrolls. However, given the elevated uncertainty in the market, as reflected in the VIX index at 26.8, even a slight deviation from expectations can have a significant impact. Historically, a beat in non-farm payrolls has led to a rally in the dollar, a decline in gold, and a sell-off in bonds, as market participants price in higher interest rates. Conversely, a miss has typically resulted in a decline in the dollar, a rally in gold, and a bounce in bonds, as rate cut expectations increase. The historical volatility pattern around this release is notable, with the average move in the S&P 500 on non-farm payrolls day exceeding 1%, highlighting the potential for significant price action. In the current macro environment, this release is especially significant, as it will provide valuable insight into the labor market's resilience and potentially influence the Fed's policy trajectory. As an investor, it is essential to understand the market implications of this report and how it may impact various sectors, such as consumer discretionary, which is closely tied to labor market conditions. Remember, this is educational content and not financial advice, so it is crucial to consider your individual circumstances and consult with a financial advisor before making any investment decisions. Technology is closely tied to labor market trends, as a strong non-farm payrolls report, indicating low unemployment, can boost consumer spending on electronics and software, benefiting companies like APL, MSFT, and Nvidia, whereas a weak print may signal slowing demand. So the key aspect to watch is the wage growth component, as rising wages can lead to increased demand for tech products and services. Healthcare, the non-farm payrolls report has a nuanced impact, with the unemployment rate being the key metric, as a strong labor market can lead to increased healthcare utilization, benefiting companies like Johnson & Johnson, UNH, and PFE, while a weak print can have the opposite effect, so a low unemployment rate is generally bullish for the sector, particularly for pharmaceuticals and biotech. Financials, specifically the banking and financial services industry, is highly sensitive to non-farm payroll data, with a strong print typically boosting sector performance, as seen in the likes of JP Morgan, BASI, and GS, due to its implications for interest rates and loan growth. A key aspect to watch is the yield curve, as a steepening curve can be particularly beneficial for banks and asset managers. Energy sector performance is closely tied to the overall health of the economy, as reflected in non-farm payrolls, with a strong print likely bullish for majors like XOM/CVX, COP, as it indicates robust demand for oil and gas, while a weak print could be bearish, so investors should focus on the wage growth aspect, which can impact consumption patterns and energy demand. Consumer sector performance is closely tied to non-farm payrolls, as a strong jobs report indicates increased consumer spending power, benefiting retailers like Amazon, while a weak report may hinder sales of discretionary items, such as those sold by HD, or big-ticket purchases, like Tesla vehicles. Industrials, particularly those related to heavy machinery and logistics, tend to be sensitive to the non-farm payrolls report, as it directly impacts the overall health of the economy, with a strong print generally bullish for the sector, as seen in companies like CAT and HON, while a weak print could negatively affect companies such as UPS. So one key aspect to watch is the change in the manufacturing sector's employment. Materials, a sector closely tied to economic growth, is significantly impacted by non-farm payrolls, particularly the change in employment within the construction and manufacturing industries, as this directly influences demand for products from companies like LAN, SHW, and FCX. A strong print is generally bullish for this sector, indicating a robust economy and increased demand for materials. Utilities tends to be less sensitive to non-farm payrolls reports compared to other sectors. However, the aspect that matters most is the impact on interest rates, as a strong jobs print can lead to higher rates, which can increase borrowing costs for utilities companies such as DUK, and so, making a strong print potentially bearish for the sector. Real estate investors closely watch non-farm payrolls for labor market insights, as job growth directly impacts demand for properties, with a strong print typically bullish for REITs like PLD, AMT, and EQAX, while a weak print may be bearish, so the key aspect to focus on is the jobs number, which influences occupancy rates and rental income. Crypto investors closely watch the non-farm payrolls report, specifically the wage growth component, as it influences inflation expectations and subsequently impacts interest rates, which are crucial for the sector, with Bitcoin, Ethereum, and Solana often reacting to changes in the US dollar and monetary policy. A strong print could be bearish for the sector, while a weak print may be bullish, so it is essential to monitor the market's reaction following the release. Commodities, particularly those closely tied to economic activity, are heavily influenced by non-farm payrolls, with the key aspect being the change in employment numbers, as a strong print tends to be bearish for gold and silver, as represented by GLD and SLV, due to a potential increase in interest rates, while a weak print can be bullish, and one thing to watch is the impact on oil prices, as reflected by USO. Forex markets are highly sensitive to non-farm payrolls, particularly the DXY, Euro to US dollar, and Pound sterling to US dollar, as a strong jobs print can boost the US dollar, while a weak print can lead to a decline, with the DXY being a key benchmark. A strong payroll number is generally bullish for the US dollar, which in turn affects major currency pairs. Trade with discipline around non-farm payrolls, remembering this is educational content, not financial advice. Like, subscribe to Financial Market Oracle, and comment below. The data is coming, be prepared, stay profitable. This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.